Okay, markets are open. What do we got here? E-mini ES down 25 points. Let me see if I could close this silver trade for $1 loss. There we go. Now let me redeploy it later. So silver is definitely on the agenda. Okay, I just needed to get out of that because I was 16 deltas short, so it was just rolling and rolling, and the IV, the implied volatility, is still up there. Okay, so $1 loss on silver. I never got the other fill yesterday. Let's go in. Okay, I'm gonna have to really look at. Okay, nah, IWM is still only. It's about delta neutral, so I'm not gonna freak out on that. Let's go to E-mini ES down 32 points. SPX should be down 32. Okay, it's down about 31. VIX futures are up just a little bit. So, it's not really a lot of fear. It's just the markets are down. Bonds. Oops. Bond. Let's go to VIX again. Yeah, okay, so VIX is up just a little bit. Bonds basically flat. So, we could look at where their markets are at. Let's go to a 5-minute chart. So bonds are up just a little bit. Applied volatility shrunk on bonds. E-mini S&P. You could tell that basically, that's been falling. And VIX, just a hair bit up. Looking at charts. Okay, so we just looked at our inventory. All we got is that IWM position. I got to redeploy, try to get some positions on. Let's look at the ones that didn't fill yesterday and see if we can possibly fill them today. Now that markets have got more volatility, which means that there's a good chance that we might be able to fill these today. Delta Airlines. I was at 147 credit. Let's go 140. Yeah, see, I'm going to continue to get up there in credit, and then I'll just bring it back during the day. It fell 75 cents. And let's just see where our deltas are at. So actually, we can actually move this around a little bit and see if we can get filled. Let's check it out. Okay, let's see. It's delta, that's a strangle, so I'm going to keep it at the 1 standard deviation. Oh, wait a minute. There's no volume. Yeah, we'll probably wait for a little bit. There's really no volume going out until December on these 1 standard deviation strikes. But I had it at 147 was my price. I'm just going to put it in just to do it. But again, there's nothing traded there yet. Let's go to we're going to do SLV again to redeploy it. Let's go to Freeport McMoran. Okay. Yeah, now we're getting somewhere. Freeport McMoran. Let's check it out. See where our deltas are at. Yeah, it definitely changed. We're up 5 deltas today from yesterday. So there was definitely a, it's up $1.60. And remember this thing, I'm allowing it to move $3 and considering average true range. No, not $3. Let's see. Okay, no, the average true range, I was giving it 20 cents. Well, but it's up $1.50 today. So it just kind of tells you, the nature of this thing. I mean, it just moved and put it up to, man. It was. Oh, wait a minute. This is a 5 minute. My bad. Let me get to a daily 1 day chart. Yeah, there you go. It just gapped like crazy. So I gave it $3 a day of movement. It's doing this regular average true range movement. $1.50 or $1.40, $1.50. So that's the ability. So let's see if the trade metric, of course, is going to change because markets went up, got a little bit more volatile. Let's get this 17 delta. Okay, 14 is the nearest delta. Not really a lot of volume. 111, we were trying to get one. So we were trying to get more. Again, is not a lot of not a lot of credit for this particular trade in Freeport McMoRan. It was much better yesterday because we were getting $1.30 at, I think, about out of $3. I may be wrong. I have to look at that again. But today, even though we're a little bit more neutral, look at the smile, the gamma. The smile is definitely quite a bit. So we're getting we'd be down out of our buying power, damn near 90% of our buying power if it goes to the upside. If it goes to the downside, we'd be down about a quarter of our buying power. So it's definitely, this bullishness in Freeport McMoRan, even though it's pulling back from its bullishness, it's, we still are not getting the credit. $1.15 out of that is not enough credit. Look at that smile. So it tells you. So I'm gonna wait for it for a little bit before putting this on because I really wanted I wanted that 130 credit. You know what we're gonna do? We're just gonna get creative. And if it gets there, it gets there. Don't it don't. That 130 credit. Let's go to next one. Let's go to KRE. Because KRE was the other one that I wanted to, and that's really hasn't moved. It got bullish a little bit, but in terms of it's still pretty much like close to delta neutral, one delta. The same metrics is still there in terms of probabilities. 127 was where I was trying to get filled, and that's 373. So yeah, I'm definitely gonna go with this one, even though it's the mid price is where you'll get filled. I just want to play with it a little bit just to see, again, see when markets settle down if that'll get us in that trade. Even though I know the chances of getting it are slim to none at this particular price, I'm just putting it up there just, to give us, just to see where markets are at. And then if I have to come down closer to mid price, I just work my way down. So I don't mind doing that. Let's check XLF. This is a trade that I was going to do last week, where I was doing, but it never filled. That was the butterfly trade. Actually, yeah, okay. Yeah, because the butterfly had moved on me. 108 buying power, which is really minimal. But we had a credit on this last time, so there's no way I could put this on because when I do butterflies for a credit, not a debit. So, oh, wait a minute. This is the opposite. Let me get the right trade. I think my eyesight just went haywire. XLF. Yeah, there we go. The credit. Okay. There we go. I think that's when I closed instantly. So yeah. I mean, it's wait a minute. Yeah, okay. It's still kind of in the wheelhouse of possible trade. Still in the wheelhouse for it, like a 1-to-1 type scenario. You know, 86% probability of profit. Wonder why it's only 15% of probability of 50%, but we're not getting much theta. So okay, that was XLF. That was just something I was looking at the other day, but I have to redeploy just because it definitely. Let me see how much it moved from. Yeah, so it moved yesterday to today quite a bit. It gapped. So okay, so we looked at inventory. We'll start looking at new trades. The king is volume. Things normally don't move as much, so you're going to see pretty much the same um, usual suspects here. Check out TLT though. I kind of like TLT, except that its index volume is only 21. The king is good. In other words, index volatility. Volume, king is perfect for TLM. That's great volume, or TLT, excuse me. The queen, IB rank is really good. It's just her index is not as good, and it has been going up 3% in the last few days in terms of, because bonds have been dropping. And there you go. That's telling you bonds have been dropping. It could get down to this low area right here. Not to say it has to, but this low area around 91, it could get there. On this thing, okay, so it moved the dollar average true range on the 14 and the 21. So it has the ability to move $2. I always double it. So I'm saying, this thing can move $2 in the next 21 days, $2 a day in the next 21 days. We have the prince, which is expected move. So we have the queen, the prince, expected move. They're expecting this to move $4 between now and December, the December expiration. Say, no, wait a minute, $5, excuse me. So we'll make it $5. We'll make it $6. Because I always pad it. So this thing can move $6 between now and the December expiration. That's the prince. Let's go. This is the prince. We're still working at the prince with the expected move. Let's go to the first standard deviation right there. That's about as close as it gets. We can go to 15, which is the 86. Next standard deviation. There's nothing traded there yet. Go to 18. So we'll set the strangle. And remember, I'm starting with strangles just to see what's happening. Okay. I'm only getting 76 cents on $1,100 of buying power. Do I want to risk that for 78 cents? I do have a probability of profit of 81% and a 93% chance I'm gonna make $30 out of this. 33 bucks. Or no, 37 bucks. No, 30, let's see, 2, 7, 3, 1, 38 bucks. Am I willing to risk 1,100 bucks to make 38 bucks? Hell no. So let's go to the condor. We'll go to the 23 because that's closest to the expected move. Again, we're working on the prince. And let's go down to, because we want to make it, well, we've got skew to the upside. When I say skew to the upside, I'll show you. If we put these around the same deltas, say 19 deltas on the downside, 18 deltas on the upside, you're going to see that it's definitely got skew. Okay. Look at the smile. It's a lot more. You remember the distance between our expiration and our, theoretical, which is day to day. At that break even right there, we'd be down a quarter of our buying power if the market got down there and destroyed us. On this side, we'd only be down less than 1% of our buying power if the market fell to our or not break even, fell to our short strike. If it fell to our short strike tomorrow, we'd only be down 1%. If it fell to our short strike to the upside because there's skew, we'd be down a quarter of 25% of the buying power. So there's massive skew to the upside. They think there's risk to the upside. Again, we could also check it with implied volatility. There's our volume, implied volatility. This one is trading at 20. This one is trading at 18. So there's definitely skew to the upside in terms of implied. So anyways, we can do an unbalanced condor to give us room to the upside. So we'll pull these in terms of our, so that's 23 on our, 23 in terms of our short strikes. Instead of 16, the delta being 16 or 16% chance, 23. And here's the kicker. You do have the probability of touch, which means, and I didn't run this to you, but I'm going to run it to you today there, Brother Will. The delta being, like 16% chance, but probability of touch is twice. When you double that, it means that market could touch that area between now and expiration. In other words, if I have my deltas, remember I said the first standard deviation is 16. That means there's a 32% chance that the market will get down there before expiration, not close there, because the delta that I have is saying that the market will close. The 16% chance the market will close there. Probability of touch is twice the delta, which means between now and expiration, you double that, and that gives you the probability that that market will, in the life of the trade between now and December, will actually touch that area. Since I'm at 23, that gives me a 46% chance that that market could actually touch this area between now and expiration. But I'm not going to freak because I've been there before. But again, anytime I get into a trade, when it touches, it tells me I'm going to be adjusting. That's all it tells me is between now and then I will be adjusting. So we'll go with a $5 spread on an iron condor. Is there any volume? There's no volume here, so TLT's out of the question for now. But I'll just put it up there just in case. In case there's not really a lot of volume. 88, $5 spread. 83, there's no volume, so there's not really a trade there unless I tighten up the strikes. And let's see what our smile looks like. Just to get, let's go ahead and expand this just a hair bit. So we would be down. If the market fell on us, we'd be down right here. It says our buying power is 426.8 into 42, about 1/5. We'd be down on the downside. On the upside, we'd be down about a quarter, a little over a quarter. Again, markets are very efficient. I got to hand it to Tom Sosnoff. He is very right. I was beefing against him on that efficiency, but he's totally right. He's 100% right. Markets are totally efficient. They will price that in for you. So what we have here is we'd only be getting 70. So we're not getting, here we have a $4 or $400, $4.26 buying power. And all we got is 70 cents in terms of our credit. It's not going to work. So I would look for TLT, a different type of trade. And I won't show you those. I was looking at like everything from Jade Lizards to since volatility is still high, we have, wait, not really. The index is only 19 in December. So the index of the volatility index is only 19. So it's really not really a lot of volatility to be selling trades in that. I do like the IB rank, but the index went down. Of course, TLT is rising. So I can't see that being any much of a trade. Look, 41 out of 159. Even if we move the strikes in, we'd only be, it's only a 41-cent trade out of 150, and that's not a third of the width of the strikes. Thanks to Tasty Trade for that metric. So let's go to another one. XLU. Let's see if that is tradable. It wasn't yesterday. It went down 2%, and I believe XLU. Let's see. IV rank is still high. King is good. Queen is good. Except for the queen, these two things are taking it off the table. You've got 20% volatility here, and it's dropped already 2% or 0.2%, which is not much. But if we went to the trade aspect of XLU, we went to December, again, only 19% in volatility. I want to see in the 30s. So XLU is off the table. Let's go. We tried XLF. I mean, we could try it. XLF financials. Here we got King is good. Queen's in IV rank is perfect. The Queen is a little better, even though it's down almost 1% volatility. Let's check the volatility here. December 20, 18%, not really good. XLF is off the table as a strangle. Let's go to some other ones. Look at TLT, it's rising. 21%. If that goes and gets more volatile, we might be looking at that TLT trade again. But right now it's off the table, no volume. Where our strikes are at, there's nothing there. Let's look at some other stuff. I really don't care about LQD. EFA, I really don't care about that. Look at these indexes. There's no volume. No volatility. We can go in. I normally don't trade LQD, but even if we went to this, let's go. We do have a lot of options volume, but the Queen is good except for the fact it's low index, even though you have a 0.1% increase in volatility. If we went to the trade, December 20, 10 on the index, you will not get, and the best way to tell, go to a strangle. 20, you go to your 16, that's about as 19 will go down here. Again, there's no volume. If we went down and did our strangle, we'd be looking at this and saying, okay, 64 cents is all you're getting on on $18 worth of buying power. It's not worth it. Getting 64 cents on or $64 on $1,000. It's again, that tells you there's no volatility, nothing to sell. XRT looks a little better, except for the fact that it's really, volatility is really being sucked out of it. So you're selling something that you might not get a good price for. So let's go into it. XRT real estate ETF, and let's check it out. December. Remember, we look at the king, the queen, the prince, and the princess. We didn't even get to the princess yet. King is not really a lot of volume, so it's not really something I run at for a strangle. The queen is okay, with the exception that it's already lost today alone 2.4% volatility, which means the price is dropping if I want to sell it. Let's go to trade. Trade December. It's up in 24, so it's it's a lot better in terms of trying to sell something. But let's go to the strangle. Again, everything I start is with the strangle. Okay, the first standard deviation, that's as close as it gets, is 18. 16, again, no volume at there, so it's not necessarily a tradable thing. But we could go one strike up, go to the 20, 21, really no volume. There's no volume there. But anyways, $1.60 of $9.90 or $9. You're only getting, 10 less than 10, about 10%. About a little over 10%, maybe 11%. It's not worth it. Especially because there's no volume. Not worth it. You could tell right here. Of course, the theoretical probability of profit theta and 50% is good. Gamma is okay. No, gamma is still 7, but look at our frown. And I think there's possible skew. There's a lot of skew. So if it shot up tomorrow, you would be down damn near 20%. If it shot up there tomorrow, you'd be down about 10%. So the thing is you're not getting paid. You're just not getting paid for this. I'd like to see this go up to like $3. If it gets like $2.50, $3 over here in terms of how much credit I could get, then and it doesn't move that up too much, or it moves it down over here. Again, market efficiency. I would get in this trade. I would probably do a condor or just keep it as a strangle. But the thing is I don't want to chew up buying power to just make $1. Chewing up $900 just to make 100 doesn't make sense. Let's keep going. Let's go to, I just got rid of the silver trade, so we're going to redeploy silver, SLV. We'll see, where's SLV on this? It's at the top. Why? Because it's maintained its volatility. And volatility is still going up. I'm glad I got out of that trade. Silver's still going up. Of course, metals are going up, and I expect it. So I have to give it. I could do what's called a butterfly trade because I want to put no risk to the upside. So I could do a butterfly trade to the downside, making sure there's what it would be is there would be no risk to the upside and minimal risk to the downside. I could do that. Oh, wait a minute. I got to get on a chart. I had the financials. Look at that. Silver just gapping and gapping and going, and it's just a runaway market. And of course, when it goes up, volatility, because it's metals, it has a tendency to increase. So if I did that, I could just sell puts on it, but I want to make more credit. And a lot of it depends on your outlook. I like to do strangles just because I like the credit aspect. So silver, $31 stock. King is incredible. Queen is incredible. Look at that. The queen is perfect. Now let's look at the individual strikes. Look at that, 38%. This is it's a great scenario. We'll go down to they're expecting, look at all those contracts there. Somebody's expecting this thing to go to $40. I'm not going to fight it. It's only 11 deltas, but those deltas to the upside have been breached, which is why I've been rolling this thing forever. Delta to the downside. In other words, they expect this market to go up. If I went and equaled these deltas, you'll see why I say they think this market will go up. I'm even going down to 15 on the upside, and I'm going 17 or 18 on the downside, and look at the skew. Even with with three more deltas look at that skew. That is called perfect, incredible upside skew. In other words, if this market shot up to our short strikes on the upside, we'd be down over half of the buying power. If it shot down to the low side, we'd be half, less than a fraction of less than like one. Let's see, 630, 1/5. So that tells you how massive the upside skew is. There's a lot of action up there. They think it's going to get to $40. The silver is going to get to 40 before December. Probably an election play. Who knows? But that's what I'm looking at. So Hotep, yeah, brother Will. So hold on for one sec. Yeah, my sinuses are killing me, and my stomach's hurting because I think I ate too much junk. And I've been out and about like all week, just walking, just going out, of course, the farmers market, the tasty trade thing, and being around folks. I hope that nobody had the zombie virus or something. But I'm just kind of I'm not feeling bad. It's just my sinuses are killing me. And then yesterday I went out and did some muscle ups because yesterday was a workout day, but my sleep schedule's upside down because anytime I drink like anything with caffeine, it just destroys my sleep schedule. So I slept mid afternoon, got up, I was feeling lazy, so I went out and did my muscle ups, did my muscle up training, and what I do is I do some muscle ups. My shoulder's still hurting, so I had to do some banded muscle ups yesterday. I start out with muscle ups, and I do pullovers, and then I do straight bar dips and pull ups. And normally on a regular workout day, I do a strength training, which is the plated pull ups and workout. I'm working toward 3 plates toward December. Brother Will, I'm going to be able to do 3 plates. By December, I'll be able to do 60% of my body weight. By March of next year, I'm going to do 100% of my body weight um, with plates because the strength, I mean, you'll literally be able to pull yourself to the moon doing weighted pull-ups and weighted push-ups. It was funny. The young cats in the gym, Brother Will, it's so funny seeing these. When I say young, I'm talking in their 40s and their 30s. And I'll get over there and I'll say, hey, man, can you put a plate on my back when I do push ups? I usually, the 45-pound plate. And they'll be like, oh, really? You want, okay. This old guy wants to do it. And I say, no, put another one on. So I'll put like a couple 45-pound plates on my back and just start repping out push ups. And what I want to do again is I'm going with 3 plates. I was going to do 3 plates today and just see how many reps I could do with because that's about 135 on your back. No, that's 90, 45. Yeah, that's about 135 on your back. So you're doing 135 plus body weight, and you're doing push-ups with that. And I was going to do either planche push-ups with 2 plates or do regular push-ups with 3 plates. And I'm thinking about doing that later on today because it just really freaks these young folks out when I do that. Yeah. Yes. Okay. Yes. Yeah. 1 drop of hydrogen peroxide. Definitely. That'll fix those sinuses up. Well, oh, definitely, brother Will. Um, so I was thinking about doing that today. I was like, you know what? I'm just going to, trick out these young folks because they freak out when, all of a sudden they're going to see me up there acting a fool with plates on. Let's see what SLV is giving us. Oh, look at that. Only 82 cents a credit. Oh, no, I can't do this trade. 82 cents of credit on $3. Oh, no. In other words, you get 81 bucks you're only getting $81 for your trouble on $3 of buying power. On $300 of buying power. I can't do that. I need more credit. And I'm not going to do condors because even though condors are okay, with the lower price of this stock, it's not worth it. It's not worth doing condors because you're just eating more, especially to the upside. If I just bought puts or sold, sold puts, I could do what's called a Jade Lizard, which is no risk to the upside and risk to the downside. You get a little bit of a credit. This one, I'd be getting a 50-cent credit, but let me see what our loss is. And if this is going to give us if we're getting a 52-cent credit, I'd have to bring this in a little bit in order to, because a 52-cent credit, $3 of buying power, I'd have to bring that in because it's still, we'd still be down. So I'd either bring this up more downside. Therefore, we have, no, we'd have to bring in we'd have to bring we'd have to bring in other words, we'd be selling, let's bring the lower one up. It would bring that up to right here. We're getting 84% credit there. $4 of buying power because of the $400. $4 of buying power. But let's see if there's any risk to the upside on this Jade Lizard. Theoretical, nope. We still have a little bit of risk to the upside, about 15 bucks of risk to the upside. So this Jade Lizard, because I was thinking about doing a lizard, which means that you'd have no risk to the upside. We still have risk to the upside. So this is not, plus our deltas, where are we at? The 35 call. Let's bring that in. $6. I don't want to bring this one up too much because that'll increase the buying power. Yeah, so that should give us, it's minimal risk right there, but it's still not where I'd want it. But this would give us no risk to the upside. Oh, wait a minute. Let's see. No. 33, 32, 33. Okay. No, we'd have too much risk to the upside on this one. I was going to try to do a lizard. And, yeah. Oops. There we go. Yeah, too much risk. Let's see where that put is at. Basically, you're selling the bottom, and you have a spread. You have the spread up top. Okay. Because I would go 30 deltas up here to get more put, but there's not enough put credit for me because I still have risk. You still have like $9 of risk to the upside doing this trade, and if you're moderately, if I were to do a Jade Lizard here, So you still got like $1 worth of risk to the upside. You still got risk. Maximum profit is 98, which what you keep out of 463. I mean, it's not a third the width of the strike or nothing, but it's it is at a 463 buying power, 463 buying power. The only thing is the risk. Just you got too much risk to the upside on this. So the Jade Lizard is definitely off the table. But I was just looking at that. It's basically a strangle with protection to the upside. That's all it is. And I was just kind of looking, just playing with the strikes to see if I could get a credit. But the best you'll do is get $1. It would only be $1. So there's basically no risk to the upside to do this. But there's risk, major risk to the downside. And if we look at our if the market went to our short strike tomorrow and just collapsed to the short strike, how much would we be down? Let's do this. If it collapsed to the short strike tomorrow, we'd be down. Okay, we'd be down about about close to, let's see, 50 into 46, 5 into 40, about 1/9, about a quarter. I mean, 1/10. Let's say 1/10 the price. If it dropped tomorrow to our short strike, and we were like, we just got to get out of this thing, we'd be down, let's say a fifth. 66 times 5, yeah, a fifth, not a tenth, a fifth. Let's see, no, 6 times 5 is 30. So it would be, 6 into, so a ninth, one ninth, because it's like, I'm saying 45, 46. So anyways, we'd be down. I mean, if it shot down there tomorrow, it would hurt, but not tear us up. But since silver has just been rising and rising and the skews to the upside, if it went to our short strike tomorrow, we'd be up money. We'd be up, pretty nicely. If it went there toward expiration, it basically no risk to the upside on this trade. But there is risk to the downside. And if it starts collapsing to us, again, I always suggest to look at silver. Remember, we want to see how much this thing can move. This thing can move $1.40. Okay? I doubled the average true range. This thing can easily move $1.40. So if it fell from where it's at 34, say, it went down, we theoretically be, if silver collapsed, we could get destroyed if it collapsed all the way down to, through our buying power. But this thing moves, I'd say $1.40. So, it's not terrible. We do have a lot of gamma risk, and we're 15 deltas long. Again, because of the fact that this is bullish. We're looking at this as being a bullish trade, going up. There's risk to the upside. There's a lot of contracts sitting at the $40 mark saying that a lot of folks believe that silver is going to hit $40 by December. And if we wanted to look, we could look at the volume that's sitting there. Look at $40. Look at all the contracts of volume that's being traded at $40 and look at how many people are holding it. You got damn near 3,500 people holding contracts at $40. Then you got 11,000 people holding contracts at $35. They believe silver is going up. Whereas if we go down to where a short strike is here, you do have at $28, 11,000 people, but look, down, at the 28, 27, 26, 25, as opposed to $40, $35. You got everybody and their mom sitting over here and their dad and their cousin Bill sitting at $40 thinking silver's going to get there. So there's a lot of contracts that are sitting up there. Not to say it's going to get there by December, but there's a lot of folks that believe it. If we look at the volume, we've got 402 contracts up at this area, but down here with those open interests, those folks that are holding those contracts, that's all open interest is how many people are still holding contracts. They're literally, nobody's there for December right now, at least right now. That could change. So this might be in the wheelhouse for a Jade Lizard. I'm going to see if I can get more credit. Now we're at $1 credit, $1 to $1 credit. I'm going to put it in for $1. Now, in terms of adjusting, again, I don't get into a trade unless I know I'm going to have to adjust. That's the thing. I'm always looking at adjusting. When we talk about the man on the hill, he's not necessarily at the top of the hill in this one because of the fact we're skewed and looking at upside movement. So the thing is we have to worry about him falling down the hill this way. And again, if he fell tomorrow to our short strike, we would have to move this to match it. And if we moved it, we'd go from $1, we get like close to 35-cent credit if he moved against us tomorrow. And that would kind of take some of the pain out of what we'd be losing on this right here. So, clearly what it is, again, if we moved it, we would definitely have some risk to the upside. Not much. Well, if it fell tomorrow, we would get that 35 cents or $35. And if it went back to our short strike the next day, or went back to our it moved back up the next day, we would be, let's see if we can get there. We would have to, no, we'd be up a little bit, just like $2 or $3. We would be up. So the thing is, we do have downside risk on this lizard. But you know what? I'm going to just sit on this for a minute and just watch a market. If silver collapses, it collapses, and we just got to readjust. That's if I were, again, this is basically you're buying protection is all it is to the upside, because silver can go up there, and as volatility, as this goes down, and notice that volatility goes down, so that also will give this guy a little bit, of a hill to stand on. Remember, this is about the hill, keeping the guy on the hill. That's what this is all about. Is trying to keep him on the hill as long as possible. There is a possibility he can fall off this hill because of the fact he's so close to the edge. Like that song, I'm so close to the I'm trying not to lose my head. He is close to the edge, but at least we're going to sit on this just to see. And again, we're getting paid $1.23 a day. We've got 84% chance of making 50%, 77% chance of making profit. We are long deltas. We are long gamma. That hurts us. We're only getting less than a quarter of the buying power. But I don't mind this because of again, it's moderately bullish, and that's in silver. And I've been rolling strikes because of silver's bullishness. I've just been rolling all year, trying to capture gold and silver, and that's just been going up and up and up. And I could give you a good context if we go to GDX, which I trade more than GLD. We go to GDX, and King, excellent. Queen, excellent. It went up in volatility, of course, because gold and silver are going up. We go to the trade. Go to this. Look at the expected move. The Prince. Expected move of around $5 either way. Good volatility on that strike. So the Queen, the King, and the Prince are saying, yeah, this is a good trade. Go down to the first standard deviation. This is about as close as it gets at 18. Go up to the up top standard deviation. And that tells you there's skew in this thing. Let's go to 18 deltas. 16. Okay, there we go. There's only one contract, so there's not a lot there. So anyways, at this 51 strike, down here, it tells you there's skew again to the upside. We would be getting $1.10 or $4, only a quarter of what's there. So it's not, again, this is if you want to do a strangle on this. Again, I start everything with strangles. There's risk to the upside. Again, many folks believe that this thing is going to hit $90 in GLD. $50. I said 90. $50 in GLD before or around December. They believe before December 20th, GDX will be $50. Again, skew to the upside. Let's go to the curve. Look at the hill. He's closer to this side. If he falls to this side and goes to that, that corner is where our short strike is. If he falls, we're down around what is that? About $80. 80, which is like 1/5 of the buying power. If we falls to the upside, we'd be down, what is that? 203, which is like 50, almost 40% of the buying power. So there's definitely a lot of skew in this particular trade to the upside. So, which means you can move this out. Problem is, again, efficiency of markets, the more you move it out, the more buying power you're going to use. Okay, in terms of if it falls against you. It's this thing, it gets bigger and it gets wider as you go up. The cost of the buying power and the cost of the ratio of buying power to short strike goes up, and you get less credit. You get less and less money. So if we were to do this, let's see, I would bring. Again, this is something you could do a butterfly because there is a lot of, but you could do a butterfly with no risk to the upside. And a butterfly is a short strike or two short strikes down here and protection on each side. And I don't know if I would do a butterfly in here. Again, I'm looking for no risk or less risk to the upside. I don't know if I would do that here. I mean, it's 69 IV rank, so I mean, it is great for butterfly trade. It's just that I don't want, because of the fact I've been trading gold and silver all year, and all year I've been moving strikes to the upside. Then again, keep in mind this is after that election, so gold and silver might normalize to the downside now that the election would be over by then. So that kind of answers some of that question when you ask about geopolitical events and how would I trade those. That kind of would say, yeah, I would take that into context. But if I didn't want to take it into context, I could put a broken wing butterfly here going around. Again, I'll do it like a condor. I'm not going to do it at the expected move. I'll do it one strike above the expected move, which is there's 18. So we're going 23. We'll do two contracts there. Okay, two contracts. And we'll do a 2-to-1. So if I went 40, I'd go up to 45 with protection. One contract up 45, one contract down to 30. And that's what's called a broken wing butterfly. Let's move these to one contracts. So 40, 30, 45. We'll make these one contract apiece. So this should have it has, wait a minute, it's a 135 debit, so there's something wrong here. 40 to 30, 40 to 45, we should be getting a credit. So if it's this broken wing, we'll move our strikes in. But it's 2 on one side, 1 on the other. So we'll move our strikes in because we should be getting a credit on this. Yeah, so we still got risk to the upside. So if we went 3 strikes on each, because my main thing is to get credit. So if I brought that in, 45 for 3, 42, 41, and then 40, 20, 38. Let's see if we get a credit to the upside, 37, 38. So if it was a 1 over here, no, wait, this is 36, so 40, 36. I want to go 2-to-1, 38. Okay. We're only getting 11 cents. But what this does, and I'll show you, is you have no risk to the upside if this thing goes up. Even though it's only 80 cents, you're getting like, 12, you're getting like 1/5 of the buying power as credit. You're only getting $12 of credit. So what it is, in order to make $112, 80 is your risk. Around 80 or $90 is your risk to make $112. You have no risk to the upside. So if silver, if GDX skyrockets, this is because what it is you've got, instead of doing the strangle, you're literally centering the you're centering the short strikes around the expected move to the downside. Then you put protection on each side of it, except for on the top where you don't want any risk, you put your protection really close. On the bottom, you put your protection a long ways away. So think of it this way. This is a bodyguard. The red is a bodyguard at a nightclub. Better yet, the red is the bodyguard protecting P. Diddy because, P. Diddy's he's red, so, he's in trouble. He's short. If the market goes beyond that, P. Diddy does 30 years. If the market goes up, P. Diddy might be lucky. He might have a good lawyer, but he's going in. So that red is P. Diddy. This bodyguard that's close to P. Diddy, he's protecting P. Diddy really good, which means he's gonna more than likely he's like a lawyer. He's P. Diddy's closest lawyer. If this lawyer is close to P. Diddy, that means chances are if it goes up in that direction, that lawyer did good. P. Diddy is not in trouble. If he goes, look how far away that protection is from P. Diddy. That means the chances are this is going to cost you more. Again, if we look at where if we look where the expiration, this time we're not going to go expiration, we'll go to break even. The break even point to where, think of this as where P. Diddy's frustration is. This line down here is the theoretical, and this line right here is the court case, where the judgment is. So the distance between the judgment of P. Diddy doing 50 years and the stress he has in theoretical, you'd be down $22. With a good lawyer that's closer, remember, this is 41 and 40, which means it's a good lawyer, closer, because he's closer to P. Diddy, you would only be down between the court and theoretical $10. So it's kind of telling you, that's double. Again, efficient markets, thanks to Tom Sosnoff, because he's always talks about efficiency, and I got to hand it to him for that. But we're going to go up there with, we're going to go up with a 13, we're going to go 15 cents credit, because it's between the mid price and, the price that you want to sell it. Again, it's about getting a good lawyer for P. Diddy. That's all this is, and that's a butterfly trade. Again, I always look at the strangle. Hey, KW, always good to see you. I always look at the sell point. Like I said, every option trade I do or any kind of option kind of strategy, I always look at what am I selling? Not what am I buying, but what am I selling? And then I put the buying around it. So if I know that, again, what we looked at on GDX, the king, queen, the king being volume, we looked at it. GDX, king, excellent, 4 million contracts. Queen, high volatility, which means it's been over, and it's higher volatility for the whole year. The IV index, which is where's the queen at now, excellent. She's even going up and getting more volatile. Then we go to the strikes. In terms of the strikes, when I say the expiration date, we go to the expiration date. Look at the volatility on the expiration date on December. December is up there. What is it? 35. That's excellent. It's over 30. So we've got king, queen. Now let's go to expected move. We got a lot of volume. So there's volume there for the queen. For the king. We still have volume on all the strikes. It's not incredible volume, but there's still enough volume to get this thing done. I'm looking, that's only giving me a 10-cent credit, but I'm trying to get 15 cents. It's anywhere between 10 and 18 cents credit. And I put in 15. If it gets filled, it gets filled. If it doesn't. So in order for us to do this, every day that this thing goes, we make 23 cents. We got a 93% of making 15%, which means we'll make $7. But the thing is, in order to make that entire profit of 115 with a risk of 85, that market has to fall. So in other words, I'm betting that this thing will go up and not fall. But if it falls, it does us wrong, it will fall right where that expected move is. Remember, we're the prince's expected move. And then anywhere in that area, we would have profit between the 41 and 39, anywhere between 41 and 39, I'd say, 38. Where's our break even? Is that 38? Our break even 38.75. We'll just say 39. Anywhere between 41 and 39, we'd be in profit. That's 29 deltas. Or no, excuse me, 38 and did I say 38? Let me see, anywhere between, say, 41 and 38. Okay, anywhere between 41 and 39, we'd be in profit. So what's 41 and 39? 41 is 29 deltas, 39 is 18 deltas. We'd be in trouble if it got over 38. So anywhere between those, we'd say, 38.70, something like that. Actually, our break even is, it's like 38.70-ish, I think. So anywhere between that, we'd be making money. We'd be okay. Okay, gamma, of course, is going to be, your long deltas. So that it makes sense. You're long 3 deltas. It's not terrible, and you got a lot of gamma. So, and this is before December. So I'm gonna keep this trade on anywhere between. We've got 12 cents to 18 cents credit. That means you're gonna get the credit, which means that you've got a 93% chance of making half that money, because again, everybody thinks it's going up. Now this thing can fall. Like I said, it could fall, and GDX moves. It moves. What do we have? Oops, let me get a chart up here. GDX moves $2 between now. It can move $2 between now and December a day, which means if it's trading here at 43, it could get to 41 overnight. If we look at the chart, we could see that it easily could get to 41. Look at that. This thing went from 41 or 42 to $43, basically $1 in a heartbeat. This thing can easily do that. Not to say it will, and it's just been going up and up and up, so it could easily turn around. If you do technicals, this is a topping pattern. It's telling you it's getting a little toppy. So, so anywhere between like 41, between here and here would be profit. Anywhere below like 38-ish, and we'd have to look at adjusting. Moving the credit. Remember, like I said, every trade I get into, I always think about adjusting. And adjusting a losing butterfly. There's, we could roll it out. Like I said, you could roll to get more credit. Or since we have our strikes so far, like we would roll this out. That would be the best way of trying to preserve this particular trade. Or if it went totally started going against us, we could roll. I wouldn't roll this down because that would cost. I'd just roll it out for this type of trade. We could get rid of this put, because this would actually be this credit spread that we have. This debit spread we have, because we have 41.40 debit spread and a 38.40 credit spread. We could, if it got in the money and we made our full profit on this, which is $1. If we made $1 on this thing, on this spread, on the top spread alone, then we would just take that spread off and just keep a debit spread on. We take that spread off, or we could readjust it and take it off, and then we can make it a ratio spread, which ratio spread has no it has no protection. The lawyer for P. Diddy would be, the lawyer down here, the bad lawyer, we would get rid of. We could get rid of, we could get rid of the bad lawyer. But I wouldn't do that, because this would still be, the market would be going against us. We could just make it a credit spread, which is, of course, just one side of an iron condor. Or if you really believe that this thing is continuing going down, you could take the debit spread here, if it made $1, and redeploy it as a call and turn it into an iron condor. So there's all kinds of things you could do. But every time I get into a trade, I'm always thinking, I got to adjust this thing. I know I'm going to have to adjust it, because it'll never go my way. I'm always thinking I'm going to be wrong. But on this one, I don't mind getting in this. Now, look at this, 12 to 20. So now we can increase our, this means that the market is going our way. So I'm going to increase from 15 cents to 17 cents and see if I could get filled. We'll go 16 cents. See if I can get filled. And I'm not going to be a dick for a tick. I'm just putting it in there just in case, just to see if I could get. So we've got the other trades on. We've got a bunch of trades that I'm just sitting on, and I'm just waiting to see, once the market settles down, to see which one of these I'm going to adjust toward the mid price. because my prices are so far away from the mid prices. I'm gonna bring my prices closer to the mid prices as the day goes. And then I'll show you in the next one on low volatility. And like I said, you have low vol again, the king, queen, the king, the queen, the prince, and the princess. King being volume, queen being volatility, prince being expected move, and princess being the whole thing. Expected move, how it works. It's looking at the technicals in the chart. That's everything. She's like the daughter that's looking at everybody, and that's what I look at now. The queen also does low volatility, and I'll give you a preview. Remember, we were looking at high volatility as a sell. We could also look at low volatility things to buy. Here you have low volatility in IV rank. The lowest one so far is SPX, and it's been going down. You have NDX. I know you like to trade NASDAQ. NDX, Goldman Sachs. These are low volatility, except for look at the IV ranks are the IV indexes are a little bit, they're a little bit higher there, but NDX looks good. It looks like a good candidate. That's the NASDAQ. And we could go into futures later, but I'm going to just do this with indexes. I could do it with the Qs, but the Qs, I'm not seeing it in there in the lower volatility. Qs are actually up there at 29%. NDX in terms of IV rank, no, it's too high. It's 40. SPX is about as NDX is too high for calendars, but because it's 40 IV rank. But we could do SPX. What I mean by calendars is now we're looking at the other side. Instead of selling volatility, let's look at buying it. We've got low IV rank that's under 20. It's around 20. IV index 20. And we've got falling volatility. So now we can look at actually, instead of buying, we look at selling. Why? Because look at this. If markets fall, it usually gets more volatile. Okay, volatility starts to go up, which is great. That's what you want in calendar and diagonals and double diagonals and stuff like that. So what I do the same thing as I do before, except I do one little extra thing. First off, I look at the strangle, and calendars and any type of buying volatility, you will be buying something that's out in time and selling something that's short in time. Remember, I always look at what can I sell. One thing, I want to look at the indexes, okay? And if they're flat, that's great. If there's a little bit higher and closer than further, that's even better. So if I were to do this, I would be looking at something in the next couple of weeks and not going out to December, because I don't like all that time. I want the milk to expire fast so I can keep the profit. But I want to keep the other milk in the back of the cooler. So in other words, calendar spreads are like this. You have milk, you're like a supermarket owner. You've got milk that just came in, and you've got milk that you need to sell by a certain date. You put the milk that you need to sell by a certain date at the front of the thing so people could buy it, and you put the other milk at the back, just like any store. A calendar is no different. I would be going out saying that if I wanted to do this, again, think of it like milk in a fridge. I would rather sell, if I say I want a calendar that's like 14 days out, that means I'm selling something, that milk has to be out of the store by 14 days, which means the other milk might be 17 days. It might be 20 days. That sits in the back. So if I were to do, say a 9-day, we'll say 9 days from now, we'll sell Halloween because the milk might get bad in Halloween. Remember I said looking at strangles? I'm always looking at strangles. Well, with a calendar, I also look at one other metric, and that's at the money. I want to know at the money where things are at. If markets get, when they get volatile, they normally go down. I'd be looking at puts. If I think that the market might be volatile, but it's going up, I would look at calls. But I would only look at, again, the skew, because that's telling you where you're going to get more of your credit. So if I went out, I could go deltas. If I go say I go out 3 strikes, 1, 2, 3. That's 11% volatility. If I go down 1, 2, 3, that's 12. So we have more credit to the downside than the upside. If we go here, that's 37. and this is selling. Actually, it's selling higher because they expect this thing to go up, but I'm getting more credit in terms of the implied volatility. So I believe that this market may go down, and remember, when it goes down, it increases. With a calendar, you don't want volatility to go out like you do on a condor. You want volatility to go up, and that's what I'm looking for. So I would do that. And SPX, we don't have to look at volume because there's massive amounts of volume. I mean, you're always going to see volume on SPX. You know, usually, I mean, contracts are, ridiculously. Let's see how this is November, no, October. I mean, we should end of month. Let's see where the volume is here. The end of the month. Yeah, we could see some volume. But anyways, if we were to do this, and that's not a morning. I don't believe that's a morning expiration. We'd say, okay, if I believe that this thing is going to go down, or at least, I'll do an at the money calendar just to see what the pricing is. So at the money, right here, that's at the money. Not out of the money like we were doing in Strangles. I'm looking at that. That's giving me. I'd be selling that for $39. That means I have to buy something against it. So that's 9 days out. And if I went, that's October 31st, 9 days out. And so if I went, I would go 14 days or even 15 days. That would give me a nine. Let's go 14 days. That'll give me, because remember, this is milk we're talking about. And this is a weekly expiration. So let me see something. If I went out, yeah, these are all weeklies. The end of month one that we're selling is not a weekly, but the others are weeklies. So, I mean, I'm not going to go all the way out to the November 15th. So, we're going to have to look at this milk. This is one of those trades where you definitely want to be in, be around the store. So let's go back. This is 9 days out. So let's see, 10, 11, 12, 13, 14, so 15. And we'll go to what was that? The 59, 58.30. 58.30, we'll buy that. And so, we sold the 9 and we bought, that's ridiculous amount of money for that. I would never do that. Oh, okay, there's no volume on this one. SPX normally, let's see, instead of November 6th, let's go 3 days out. 10, 11, 12. So the 14th, 9 to 14th. So if we did that, it's still kind of a lot of money. It's going to cost us $10 in buying power or $1,000, and I don't want to do that. At least on SPX, I'd probably do it on E-mini or SP. I would do this on spiders. But anyways, it's just showing you what a calendar looks like. You could actually see it better on Thinkorswim, but because you could see the tint. Even though you'll never know what the probability of profit in this one is, because the fact that it's a moving target, for lack of a better term. The thing is the expirations are different, so it's kind of, I won't say impossible, but it's really hard to tell the probability of profit on this thing. But Thinkorswim has it. They will show you, and you'll see the tint. TD or Tasty, you won't see the tint. But this one pays you $42 a day for the 4 days that you're going to be in there. 40. So you'll get it's like 10% of the buying power that you'll get if you stayed the whole thing. The thing is I would not stay in this trade the entire time. I would take this trade, and I would only stay in 25% of the time between now and October 31st. I would only stay in, 25% of the time. And the thing is, if we look at the movement of this, how far could this thing move? They're saying by October 31st that this thing can move $85 up or down. Easily, $85 up or down. So, and that's in our expected moves. That's our expected move. Where we're at right there, we're looking at what is that? Where's the market at now? 58.30. It would be a what is that, 57.40? What would that be, like 50, let's see, 57.40, something like that? So this thing could easily get that. Yeah, that's around 22 deltas. So it could easily get there. Not to say I would put this trade on, but if I did do this, I would have to be out. If I put it on now, October 22nd, between now and October 31st. So what is that? It would be, that's 9 days out. I'd only be in this the same no more than 3 days. We're looking at a 54%, I mean a $54 move up or down. I'd have to be out of this by the 25th, be out of this trade. I'd be getting $43 of credit per day to hold this, and $10 of buying power, which I did. If I did this in the spiders, it would cost me $100, and I'd be getting $4 a day in credit. And let's analyze this. Let's analyze this. Like I said, I like the Thinkorswim one because you could actually see it graphically. But if we analyze this on SPX and say the market stayed where it's at, didn't go anywhere, and Theo spot price, we're gonna say 58.33, and each day that this thing would go, 3, 4, 5. What would, and say volatility stay, all things being equal? Do I use per contract IVs or not? No. All things being equal, what is that? Total profit on this. It should be more than that on this. All things being equal. Theoretical profit, all things being equal. What is that? $100? So we'd make about 8% on this. All things being equal, we'd be what, about 8%? This is just a profit loss open now, but if the theoretical price, all things being equal, we'd make about 8% if this market didn't, if it just stayed where it's at and didn't go anywhere. Now, if it fell, I hope I got it right. If it fell, let's say it fell like back like that. What was the expected move there? $54. And what is that? Let's see. Oh wait, by the 25th, and it fell $54. $54. That would be 9. Minus 5, 70, 57.79. So if it was at 57.79, 54, yeah, 57.79, and we did that. If volatility went up, because normally it goes up when markets fall. Volatility goes up. Okay, per contract IV. See, that's the thing. Okay, this is why. Okay, per contract IVs. I had it per contract IV. So if we did that, let's go to the strikes that we're looking at. Okay. And volatility goes up, like, say, 3%. And, 1031, that's 1031. Yeah, because we're not going to get, let's just reset this. Yeah, that's our expiration is 1031. So volatility goes up. And, okay. We'd be up if volatility goes up on 1031. See, let's reset that. Okay. 14%. Let's say it goes up to like 19% vols. I'm just thinking, if we're up 5% volatility, we should be making money, all things being equal. expiration date. I mean, or out at that market falls. We should be making some, but I guess since it's at the money calendar, um, it would be falling off on us. So I could see that. We would be losing at that calendar. So I wouldn't. I'd have to adjust the strikes to get more date on that long option to get more extrinsic value out of that long option. Because I'm looking at it again on this. You know what? Let me put it on Thinkorswim, and I can show you a little differently. So we got a 9-day and a 14-day calendar at 58.30. So let me get Thinkorswim up here. Let me see. I got to close the other session that I have on my other computer first, because now that they're with Schwab, you can't have two different sessions on Thinkorswim. So let's do this. And we got a lot of trades out there right now. So let's do this. Open up Thinkorswim. And always good to see you, KW. Let's do this. Thinkorswim, and we'll just see what goes and how we can manage this trade. Because that's a 58.30, and we got a 9 and 14-day calendar. That's the only reason why I kind of, I mean, even though that the expiration graphs mean nothing for calendars, but I'm just showing you what would happen on lower volatility. 9-day calendar with the, basically you're selling the short dated milk and buying the long dated milk. And that's what I'm looking at for this particular, for SPX, and in hopes that volatility goes up. Whether the market falls or doesn't, I just want volatility to go up. And, that's what you do when it's the other side. And when it's not a volatility buying trade, you're selling volatility now. I mean, you're buying volatility now. The other ones, you were selling volatility. So now you're buying it back. Today I think I will do some major push-ups. I mean, yesterday was pretty good. When I went to the park, did my muscle-ups, did my pullovers. That was great. Because I didn't think I was going to be able to do it. I was tired, and I said, you know what? Let me just see what happens. Went out there, and I was like, damn. Said, all right, because I hadn't done muscle-ups in like 2 weeks in terms of like just pure muscle-ups. Like most of the days I do a push day, and I start out with muscle-ups, but not very many. And then I'll do, I'm working toward planches right now and handstand push-ups. And also, I'm looking to see if I could find a gym that has a sandbag, because these cats that are doing sandbag training, they're like lifting like 100 and 150 pound sandbags over their heads. I was like, I got to do that. I mean, that's like pure strength moves, kettlebells and sandbags. And I've really been like watching a lot of, like I've been working with kettlebells for like probably the last month, not really as deep as I'd like to, but I've been really, really getting into that. Trying to just, bring my strength up. I want my strength training to double. Like they say, farm boy strength. Let's take a look at Thinkorswim, and I could show you better than I can tell you. And we'll look at the same calendar, SPX calendar. Let's go trade, SPX. We'll go in, that's the underlying. We're going to wait until we get the calendar up. October 31st, we're going to sell 58.30 at the money, and we're going to buy 4 days later. 30th of the 4th, we'll go to the 13th, the 13 days, 58.30, and we'll buy these. Okay, why did it give us 840 where the other one gave us? Is it because of the expiration that I got? I got a weekly, and let's see what that end of the month. Did I go end of the month? Probably not. That's probably why. No, we're cool. What? This doesn't give us that end of the month expiration like the other one. Anyways, so I must have done something wrong in the other one. This is giving us an $8 debit. I wonder why the other one was 10 on Tastyworks. Anyways, we'll analyze this trade so you can see what it looks like. See? So if this thing falls to 57, that's why if it fell to 57.49, you would be down, but not as much as that. I really got to get into the Tasty Trade analytics because I was doing something wrong on that. But this is your how your tent would look. Remember, it's about keeping the guy in the mountain. This time, you're not selling volatility; you're buying volatility. And so, between now and you're only going to stay in this trade 25% of the time. So so you're really going to stay in until the 25th of October. And this thing has an expected move from where it's at. It's got an expected move of 25th of October, $62 either way from where it's at. So this thing could, again, I would probably do a double calendar, but I'm just showing you what a calendar looks like. This thing can move from, let's see, 58.30 minus 62. 58.30, oops. 58.30 minus 62. 57.68. So this thing, you would be down like $135 if this thing, if it gets to close to the expected move, which is the 25th. You'd be down about $130 on the downside. 58.30 plus 62 plus, oops, 58.30 30 plus 62. And then you would be up, that's 58.92. You would be down about $100 on the upside if this thing moved against you. But normally when it goes down, volatility goes up, which makes the hill go up. So that way you'll be making a little bit more money if volatility goes up. So like, for instance, if volatility went up, we'll go Black-Scholes model. If volatility goes up 5% on the 25th, by the 25th, volatility goes up 5%. Instead of being, and this thing hit your expected move, instead of being down 100, you'd be down like 75. If the market went nowhere, you'd be up $90. On the upside, you would be down like $30. And that's with a 5% volatility spike, to the upside. And that, going up. Let's see. Let's just double check because I might have it wrong. I haven't done this in a minute. Yeah. Oh wait, no, I'm wrong. I had this wrong. Hold on. Let's go 5% volatility up. See, if it goes up 5%, you would be up much. Yeah, you would be up and not down. You would be up like and that's 5% volatility. You'd be up like around $200 if this thing, decided to go up in volatility and it falls a little bit. Say it fell and the price went down to your expected move of 57.70. What was it? 78. 57.78. The price went down there. The price went down to 57.78. Volatility is up. Theoretical. I mean, you should be making more than what it's showing. Oh wait, let's reset the slices. That's why. Reset the slices. You'd be up $300 if the price fell and volatility went up, and that's a calendar because you're buying volatility, and that's if volatility went 5%. Even if it went up only 1%, you'd still make money. If it only went up 1%, you would still, what is that like? No, you'd be down. You'd be down about $35. And that's with only a 1% volatility spike, and the market goes all the way down to that expected move. So you would only be in this trade for like 3 days. You know, I mean, and that's just a regular calendar. Normally, you would do a double calendar because that is literally it's like an iron condor. You don't care whether the market goes up or down. It just needs to stay in a certain area. And so that's why you would do, that would be the double and not just the regular calendar. But that's the other side of volatility. That's buying volatility. And but we'll do a whole session on that. But right now, again, and that's income trading. This is not about, trying to make money and get rich right away. This is just getting income. Anyways, just wanted to give you the little heads up, and so that's about it. We got some trades on, just, kind of letting you know what's going on. Anyways, Hotep.